You're about to retire, and you do a thoughtful Roth conversion to your Roth IRA. 2 years later, a letter shows up, and you read that your Medicare bill jumps by $88 each per month. That's over $2,100 a year for the two of you for crossing a line by $1. Ouch. Hi, I'm Philip Smith, financial planner with Tide Pool Wealth Strategies, helping people close to retirement create a tax-smart, dynamic retirement planning strategy with clarity and confidence. Welcome to the perfect retirement plan. Are you close to retirement and working through your retirement planning, or maybe recently retired and still comparing retirement strategies to try and build some confidence in your first few years? If you experience a sudden market drop, forcing you to reduce income distributions, or you have a one-time income spike from something like a large bonus, a Roth conversion, or a property sale, Medicare's income-related monthly adjustment amount, or IRMAA, can turn into an unwanted extra. Today, we will make sure you know the rules and the moves to try and avoid this additional cost. Here's where we are waiting today. First, IRMAA basics in plain English. It is plain as I can make it, I'm sorry. Sometimes it's just jargon that you can't get away from. Then, we'll talk about why the low tide tax window right after you stop working is the best time to plan. I will walk you through the strategy playbook I use with clients, the common pitfalls, and a quick case study. And then we'll wrap with clear action steps you can take this week. Let's start with those IRMAA basics, what it is and how it hits. IRMAA is an extra charge added to Medicare Parts B and D when your modified adjusted gross income is over certain limits. It uses a 2-year look back. So today, your 2023 tax return sets your 2025 Medicare premiums, or your income this year will determine your Medicare premium 2 years from now. For context, in 2025, the standard Part B premium is $185 per month. At the first IRMAA tier for married filing jointly, income above $212,000 up to $266,000 adds $74 per person to Medicare Part B and $14 per person per month to Part D. That makes the total Medicare premium for Parts B and D $273 per month at the first tier. If your income goes $1 over that tier, you pay the higher amount for all 12 months. We used married filing joint as our reference throughout this podcast because I don't want to complicate you with a jumbled bunch of numbers. But if you are single, the thresholds are exactly half of the joint filing numbers. Now, here's why this matters now in that low tide tax window. The first few years after you stop getting a paycheck often bring your lowest taxable income. Social Security may not be on yet. Required minimum distributions have not started. That creates space to make tax moves on your terms. I call it the low tide tax window. Handle it well, and you can fill lower tax brackets, steer clear of Medicare cliffs, and reduce lifetime taxes. Ignore it, and you can trigger surcharges you did not need to pay. Here's the strategy playbook for how I guide clients. It's the framework I use with people who are close to retirement or recently retired. We'll map first the multi-year income. We generally try to project a few years of modified adjusted gross income. That includes some assumptions on dividends, interest, part-time work, Roth conversions, capital gains, and any property sales. We layer in the year Social Security starts and the year RMDs begin. Then, annually, we'll review the room for Roth conversions. Hey, converting from a traditional IRA to a Roth IRA is a taxable event. That means the conversion will count as income. We pick a target bracket and build a buffer under the IRMAA line when and where possible. I gotta admit, it's not always possible. For example, if the joint Tier 1 line is $212,000, we might cap projected income at $205,000 to $207,000. Leave a little room for surprise capital gains or something like that. We commonly convert at the end of the year currently, but there's a lot of reason to consider other methods of conversion timing. One could convert early in the year, throughout the year, or near year end, depending on a number of different financial factors that are specific to their situation. We also work through harvesting gains on purpose. In low income years, we may realize long-term capital gains to reset cost basis while staying inside a target tax bracket. That gives you future flexibility. We pair the gains and conversion with deductions. If possible, we'll work with clients to try and get larger deductions or charitable gifts in the same year as conversions to keep income inside the lane. So important to note here is that we have something like the SALT cap, which has been temporarily increased. So this would be a good time to utilize that increased deduction capability in order to leverage something like larger Roth conversions. So those Roth conversions can reduce future required minimum distributions, or RMDs. Small annual conversions in your low tide window can shrink later required withdrawals. At age 73, you can also use qualified charitable distributions to send IRA dollars to charities and lower your taxable income. Remember that tax-exempt bond interest counts in the IRMAA formula. If you shift into municipal bonds in retirement, they can get some favorable tax treatment, but can still push your modified adjusted gross income, or MAGI, higher, even though they are tax-free on your return. Now, to round this out, let's touch on appeal. No, not like charisma or the Riz, as the Gen Z slang goes. I mean, when life changes, like if you retire, lose a spouse, or have another life-changing event that cuts your income, you can submit an appeal to Social Security to reduce your IRMAA. You use Form SSA 44. It's at least worth the attempt. Now, keep in mind these pitfalls to avoid. First, the one-and-done conversion. A single huge conversion can push you over 2 IRMAA tiers pretty easily and raise costs for a full year. Gentle simmer beats a deep fry. Second, those year-end surprises. Selling a rental in December or taking a large distribution late in the year can blow up your income. If possible, move big taxable events into January of the next year. Work it out with your tax pro and your financial advisor to make sure you get good advice on this. Third, the dreaded widow bomb. When a spouse passes, the surviving spouse experiences joint tax thresholds that become single tax thresholds, but usually with almost the same amount of income. That means the barrier to higher taxes are half as high. We try to plan future income and taxes with the survivor in mind. Here's an example of a case study to consider. Linda and Carl, we'll say, are both 63. Their planned income this year without retirement or tax planning is $120,000. So we build a buffer lane, some room to reach $207,000, and still keep some wiggle room under the joint Tier 1 line. So with this, we can convert, say, $87,000 to their Roth IRA from their traditional IRA in quarterly chunks. Harvest a small gain in the brokerage account and leave a $5,000 buffer. That's that gap between 207 and 212. 2 years later, their Medicare letter shows the standard premium with no surcharge. Successfully executing this strategy a few more times over the next few years, find that when they reach 73, required minimum distributions are much smaller and their lifetime tax bill is much lower, and those annual taxes are smoother, which is something to consider. Let's take some action on this. First, pull last year's tax return and circle your modified adjusted gross income. Second action, write down your expected income items for the next 2 years. And third, set a target income lane under the IRMAA line and decide how much to convert this year. Now, IRMAA line, those IRMAA tiers, they're pretty easy to find online. You can always reach out to our office. We're happy to have that discussion with you. Anyhow, so once you decide how much to convert that year, if a Roth conversion makes sense in your situation, then you'd move on to 4, schedule a check-in with your advisor and your CPA before Thanksgiving to confirm the numbers. And 5th, or last action item that I'll lay out here, if you had a life change that cut income, file that SSA 44 appeal with Social Security. Now, if you want a deeper dive on how IRMAA fits into the bigger picture, listen to my episode, How Can I Avoid a Tax Bomb in Retirement? And watch the companion YouTube video. Links are going to be in the description. And remember, it's not about having the smartest financial advisor, the most money saved, or the highest probability of retirement success, whatever that means. The perfect retirement plan for you is the one you act on. It's disclosure time. This podcast is intended for educational purposes only, should not be used for any other purposes. The views depicted in this material should not be considered specific advice or recommendations for any individual, are not intended to be financial, tax, or legal advice, and are not representative of Type Wealth Strategies or Cetera Wealth Services, LLC. The opinions contained in this material are those of Philip Smith and not a recommendation or solicitation to buy or sell investment products. This information is from sources believed to be reliable, but Cetera Wealth Services, LLC cannot guarantee or represent that it is accurate or complete. For a comprehensive review of your personal situation, always consult with a financial, tax, or legal advisor. Neither Cetera nor any of its representatives may give legal or tax advice. Our office address is 450 Country Club Road, Suite 350, Eugene, Oregon 97401. Securities offered through Cetera Wealth Services, LLC, member FINRA SIPC. Advisory service offered through Cetera Investment Advisors, LLC, registered investment advisor. Cetera is under separate ownership for any other named entity.